Let's study the smart liquidity concept so that the market makers don't take our stop losses. You can see here the liquidity is being created as inducement. Here goes the liquidity and we are in a 69-hour trade. Institutions can't trap me. Haha.
Surprise, motherfucker.
Hello traders, I hope you are doing well. So today we are going to discuss liquidity and how to effectively use it. So this video is basically divided into 3 parts. First of all, we will discuss what is liquidity and some myths about it. Secondly, we will discuss how to spot liquidity and liquidity types. Thirdly, we will discuss liquidity and how to use it on news. So let's get straight into the point and discuss what is liquidity. Liquidity is basically the sum of market and limit orders at a specific price in the market. Suppose at a price of 100 you have 50 limit orders and 50 market orders. So the total liquidity in the market would be of 100 orders. The basic concept of liquidity is this, that it is the sum of market and limit orders at a specific price in the market. So now let's burst some myths about it. Firstly, the number of buy orders in the market and number of sell orders in the market are always equal. So if you hear someone saying there are more longs in the market than shorts, or there are more shorts in the market than longs, you can clearly know that he doesn't know about liquidity. Market delta is something else, and that we will discuss in another video. Another common myth about liquidity is that market makers are there to hunt your stop losses and they are some sort of an evil stuff. But that is not the case, and it is basically the necessity of the market. Suppose for example you need to buy 100,000 lots of either GBP or BTC. If you market execute all the orders at a single price point, the price will shoot up. This will cause a lot of slippage, and the big institutions and the market makers won't be able to execute their orders at the perfect price. Instead, what they do is that they take orders in bunches and execute most of the lot sizes when stop losses of retail traders like me and you get hit. So let's look at an example. Suppose a market institution has to buy 100,000 lots, so he will buy 25,000 here, 10,000 here. Now he has remaining 65,000 lots to buy. What he will do is he will push the price down, take these stops out. This will be the area where our stop losses will be present. When he will take our stop losses, this will generate enough liquidity to fulfill the remaining 65,000 lots, and this is how they fulfill their 100,000 lot size orders. It is not that the market makers are evil or something like that. It is basically the necessity of the market to take your stop losses before going forward. Myth number 3 is very common and is very absurd, as people think that while looking at the candlestick chart they are looking at an order flow chart. Instead, an order flow chart looks something like this. We will discuss how to read this in the following videos. Part 2, what are some liquidity types and how to spot them. There are basically 4 types of liquidity zones or areas. Firstly, we have the swing highs and swing lows. Secondly, we have the range highs, range lows. People also called it like equal lows, equal highs. Thirdly, we have the order blocks. Fourthly, we have the trend line. A common mistake I see people making here is that they apply every type of liquidity zone on every kind of time frame. For example, they would be taking trades from 1 minute order block. This is a very cliche and retail way of taking trades, and you will face many losses like this because each liquidity zone has an optimum time frame in which its win rate is the maximum. So let's look at the first liquidity zone, swing highs and swing lows, and I would suggest you to trade it on time frames greater than 4 hour or at least 4 hour. So let's look at an example. So here we have a GBP USD chart on the daily time frame. You can see here is the swing high, here is the swing low. So our main liquidity is resting either at the top of the swing high or the bottom of the swing low. So let's see if any of this liquidity gets taken and we get a trade. You can see the swing high liquidity was taken. Let's place a short here with a stop slightly above here. We do the take profit on the swing lows and just widen the position. So let's see what happens with the position when the swing high liquidity has been taken on the daily time frame. So as you can see, it perfectly took out the swing low and we had a like 5 to 6 hour trade that played out perfectly. Why? Because firstly we targeted the swing high liquidity, and secondly it was on a higher time frame such as the daily. Now let's see the same example on a 1 minute time frame. So here is the GBP USD chart on the 5 minute, this being the swing high, this being the swing low. So let's see which liquidity gets purged first and we have a trade. So let's move it forward. Here you go. As you can see, the swing high liquidity got taken. If I place a short position here with a stop loss right above here and targeting these lows, let's see what happens. Here you can see our stop got hit. The setup on the 5 minute and on the 1 day time frame was exactly similar, but the main difference was of the time frame. So it is advised to use the liquidity zones in the optimum time frame. For the swing highs and swing lows, I would suggest you to use a time frame of greater than 4 hours. So now let's move on to the second type of liquidity zones, that is range highs or range lows, or more people like to call it equal highs or equal lows. The optimum time frame for these type of trades is anywhere greater than 15 minutes. So let's look at an example. So here you can see on the GBP USD chart on the 4 hour time frame we have created equal highs. Let's see what price does after taking these highs. So here as you can see, it has taken the equal highs on the 4 hour. Now according to the plan, we must place a short here with a stop loss right above here and target these lows. So let's see what happens. So you can see we just apply the simple equal highs or equal lows or range highs or range lows concept on the 4 hour, that is the higher time frame, and took a trade on the liquidity sweep. So this gave us a 6 hour trade which was successful. If you apply these type of concepts on the higher time frame such as the 4 hour or the daily, it will give you a higher win rate. Moreover, the equal highs and equal lows concept also work on the lower time frame such as the 30 minutes. Let's look at an example on the lower time frame. So this is the EURUSD chart on the 30 minutes. You can see we have created equal highs and equal lows. So let's see which side we have the liquidity sweep first and take the trade then. So here you can see we had a liquidity sweep on the 30 minutes of these equal highs. If we take a trade here, placing a stop somewhere around here and targeting these lows, let's see what happens. So as you can see, we secured a 6 hour trade even on the lower time frame by simply applying the equal highs and equal lows liquidity concepts. Now let's move on to the third type of liquidity zones, that is the order blocks. I specifically use the weekly order blocks and focus on no less time frame than weekly because I find my win rate really drops. So let's look at an example of a trade from a weekly order block time frame. Here you can see on the weekly time frame we have a weekly bullish order block and price is stagnating in this order block, so you can punt along here. So let's say if we take a long on these prices and place a stop loss slightly down here and target these highs, let's see how our trades play out. So as you can see, using the weekly order block liquidity, we had a 4 hour trade. So I use only weekly order blocks and no order blocks smaller than that because I have seen that they really decrease my win rate. So the fourth type of liquidity is trendline liquidity. I don't really use them and I haven't back tested them, so I don't really have any examples of them. You can see any other YouTube video for that, but I don't have any real life examples for that and I don't really use them because my win rate really drops in them. So our third topic is liquidity and news. Usually when you are trading lower time frame liquidity ranges or price is near higher time frame swing highs or swing lows and there is a news in the week, wait for the news to happen as it will provide you the optimum liquidity purge to take your trade. I have seen many traders gamble on the news and lose money, so I have identified a 3-step process for you as to how you should trade liquidity on news. Let's move on to the charts to understand the 3 steps. So here on the EURUSD chart on the 4 hour, you can see I have identified some equal highs to be taken and we have news on the arrow. This news event is on the arrow. So let's see what happens on the news event. Let's move forward. As you can see, we had a liquidity purge on the news event. Here we liquidity swept all these highs. So now I would be looking for a short here. Now let's move forward. Let's see how this trades play out. Here you go, we secured a 6-hour trade by utilizing liquidity on news. So what did I did actually? Step 1 was identifying my liquidity zones, that is the equal highs. Step 2 was to wait for the news and wait for a liquidity purge of those equal highs. Step 3 was identifying weakness on the lower time frame to enter the trade. Now you might question as to where did I identify weakness on the lower time frame. So that comes in the execution triggers part, and we will discuss that in the next video. I hope everything is clear up till now in this video, and I hope it helped.